Today we're doing a complete breakdown of ASC 718. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a world where companies could grant stock options without ever showing their cost on financial statements. ASC 718 changed the game by bringing transparency and accuracy. Now, a $10 million stock option grant appears as an expense, impacting earnings like any other cost. You'll soon grasp why this shift matters for investors and businesses alike. ASC 718 was a game changer in financial reporting for stock-based compensation. Previously, companies could grant stock options without reflecting them as expenses, creating a distorted earnings picture. The standard mandates these be recorded at fair value, bringing clarity and comparability to financial statements. With this transparency, investors can better assess a company's true financial health, ensuring informed decision-making. ASC 718 impacts any entity issuing stock-based compensation, effective since June 2005. Public and private companies alike must now recognize these as expenses, ensuring their fair value is reported. The requirement to use valuation models like Black-Scholes enhances comparability. With enforced disclosures, stakeholders gain insights into valuation methods, ensuring a transparent financial landscape for all involved parties. The stock compensation model under ASC 718 is pivotal. It employs financial theories like Black-Scholes to determine fair value for stock options. This consistent valuation ensures accurate and comparable reporting, crucial for stakeholders. Interviews often probe understanding of these models, highlighting their importance in financial reporting. Grasping this concept is vital for aspiring finance professionals to excel in both technical and practical financial discussions. Scope defines the boundaries of ASC 718, and getting it wrong can lead to serious errors. Candidates frequently forget that transactions with non-employees aren't covered by this standard, a common interview trap. Understanding both inclusions and exclusions helps ensure accurate financial reporting and can prevent costly mistakes. ASC 718 principally applies to equity-based compensation, essential for companies offering employee stock options. Performance shares and restricted stock awards also fall under this standard, ensuring accurate compensation cost recognition. By explicitly including these instruments, ASC 718 provides a framework for valuing and reporting equity compensation. For instance, an employee's stock option plan must be measured at fair value to reflect true costs. Understanding exclusions is crucial. Many stumble on transactions with non-employees, which ASC 718 does not cover. Similarly, cash-based compensation isn't included, as the standard focuses on equity instruments. Knowing these exclusions prevents misapplication and ensures compliance. For instance, a bonus paid in cash should not be accounted for under ASC 718, unlike stock options, which are. Share-based payments are transactions where a company exchanges equity, like stock options, for services. This creates a need for fair value measurement to accurately reflect compensation costs. For example, if an employee receives stock options as part of their salary, those options must be valued at market price at grant date. Understanding this definition helps ensure clear and precise reporting, crucial for investor analysis. Fair value is the price at which an asset would change hands between market participants. This measurement is vital for stock option valuation, ensuring transparency in financial statements. For instance, a company's stock price at grant date serves as the basis for fair value calculations. This approach aligns reported figures with market realities, essential for accurate financial analysis and comparability. Does ASC 718 apply when a company issues stock options to a consultant? No, it doesn't. This standard strictly covers employee-related equity transactions. Similarly, employee stock purchase plans with non-compensatory terms fall outside its scope. Grasping these nuances helps avoid pitfalls like misclassifying cash bonuses or future equity commitments. These edge cases are essential for precise compliance, especially in interviews. When a tech startup grants options to employees, it isn't just generosity, it's about future profitability and retention. ASC 718 clarifies how these stock compensations are recorded, making financial statements clearer and more comparable for stakeholders. ASC 718's stock compensation model systematically addresses how to handle share-based payments. For Meridian Corporation's $10 million SaaS contract, we'll explore each phase, identifying arrangements, valuation, recognition, modifications, and disclosure. This structured approach ensures equity-based compensation is reflected accurately in financial reports, enhancing clarity for investors and management alike. Identifying the type of share-based payment arrangement is crucial. For Meridian Corporation, we determine whether the stock options offered alongside the $10 million SaaS contract are equity or liability-based. Misclassification here typically leads to inaccurate financial statements. ASC 718 mandates distinguishing between equity instruments and liabilities to ensure correct reporting. Understanding the nature of the arrangement affects all subsequent steps, impacting how expenses are recognized throughout the contract term. Once identified as equity-based, Meridian Corporation must accurately determine the fair value of the stock options granted within their $10 million SaaS deal. Employing market prices or models like Black-Scholes ensures precision. A common pitfall is neglecting key assumptions such as volatility, which distorts the valuation. ASC 718 stresses using observable market inputs for reliability, thus ensuring that the reported compensation expenses reflect true economic costs. Recognizing compensation cost over the requisite service period aligns expenses with the benefits as they are earned. For Meridian Corporation, the fair value calculated in Step 2 must be allocated over the service period of the employees. Missing the timing here leads to financial misstatements. ASC 718 requires this systematic approach to ensure expenses are matched with the period in which the employees provide services, maintaining financial integrity. Handling modifications requires attention to whether changes lead to increased fair value or a shift in classification. If Meridian Corporation modifies option terms in their $10 million SaaS contract, it's essential to determine if these modifications affect fair value. Ignoring these impacts could result in significant reporting errors. ASC 718 stipulates a remeasurement if modifications enhance fair value, ensuring that financial statements remain accurate and reflective of current conditions. Comprehensive disclosures ensure transparency in financial statements. For Meridian Corporation, detailing the valuation methods, assumptions, and implications of stock options in their $10 million SaaS contract is critical. Insufficient disclosure can obscure the true financial impact of these compensations. ASC 718 requires detailed disclosures, enabling users to understand the nature and impact of stock-based compensation, thus fostering informed decision-making by stakeholders. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 718 requires choosing between intrinsic value or fair value, with specific disclosures ensuring transparency. It's crucial to understand both to avoid financial misstatements and to meet compliance requirements. Recognition and measurement of stock options under ASC 718 start at the grant date, when performance conditions are deemed probable. Fair value is determined through models like Black-Scholes, capturing market dynamics. Understanding service conditions is crucial, as they can shift recognition timing, though non-market conditions don't alter fair value. Precision here prevents significant accounting discrepancies. Once recognized, stock options under ASC 718 are remeasured only if service or performance conditions change. Liability awards require ongoing reassessment, unlike equity awards. Market conditions don't affect subsequent measurements post-grant date, ensuring stability. However, any modification that alters fair value necessitates adjustments in financial statements, highlighting the need for vigilance in tracking changes. ASC 718 dictates clear presentation guidelines. Compensation cost appears in the profit and loss over the service period, impacting profit margins. Equity awards are listed under the equity section on the balance sheet, while liability awards are recognized as obligations until settled. Comprehensive notes must disclose assumptions and methods, providing stakeholders insight into valuation and accounting judgments. ASC 718 mandates disclosures crucial for transparency. Companies must detail the methods and assumptions behind fair value calculations, enabling analysts to assess reasonableness. They should report both recognized and unrecognized compensation costs, revealing future obligations. The nature and terms of share-based arrangements must be clear, impacting strategic decisions. Disclosures on modifications help stakeholders understand shifts in financial performance and position. Imagine a CFO managing stock options under ASC 718. Opting for fair value, they enhance transparency. The annual report highlights $5 million in unrecognized compensation costs, signaling future expenses. A $10 million liability is noted on the balance sheet for outstanding options. Recent modifications necessitate a $2 million adjustment, showcasing the dynamic impact of strategic decisions on financials. Meridian Corporation, a global manufacturing company, grants 100,000 stock options to its key executives. These options are part of a performance incentive plan. Discover how these transactions unfold in the accounting records and impact Meridian's financial statements. ASC 718 mandates recognizing compensation expense for stock options over the vesting period. Here, Meridian Corporation records $1,200,000 as compensation expense, calculated as fair value per option multiplied by total options. This entry reflects the cost of granting options and increases equity through additional paid-in capital. The annual recognition of compensation expense under ASC 718 aligns with the vesting schedule. Meridian records $300,000 as a periodic expense, reflecting 1 year of vesting for the options. This entry maintains the linkage between service and expense recognition, ensuring accurate financial reporting. ASC 718 requires adjustments for forfeitures to ensure compensation expense aligns with service periods. As 5,000 options are forfeited, Meridian reduces additional paid-in capital and reverses $60,000 of previously recognized expense. This correction reflects the updated estimate of options expected to vest. Upon vesting completion, ASC 718 directs recognizing the remaining compensation cost. Meridian finalizes with an $840,000 entry, summing up the total adjusted expense. This final recognition ensures all service-related costs are captured, aligning expenses with the vesting timeline. When options are exercised, ASC 718 moves recognized costs into equity accounts. Meridian receives $500,000 cash from option exercises, transferring $600,000 from stock options to common stock and additional paid-in capital. This conversion solidifies equity growth as options turn into shares. Expired options require reclassification under ASC 718. Meridian debits additional paid-in capital stock options, moving $240,000 to additional paid-in capital. This entry marks option expiration, maintaining accurate equity records and acknowledging the lapse of these unexercised rights. The completion of Meridian's stock option plan signifies a critical evaluation point. ASC 718 ensures all costs are captured as the plan concludes. This closure verifies compensation costs match service periods, securing the integrity of financial statements. Meridian's equity reflects these executive incentives accurately. Every Big Four and investment bank interview on ASC 718 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 718 is about stock compensation accounting. It ensures fair value is recognized and expensed over vesting periods. This framework prevents underreporting of compensation costs. A classic mistake is confusing it with intrinsic value measurement. Remember, fair value captures the true economic cost of stock-based compensation, which affects reported earnings. ASC 718 exists to address inconsistent and misleading accounting for stock-based compensation. Before its introduction, companies could understate expenses. It mandates recognizing the fair value of equity awards, aligning reported expenses with economic reality. Avoid thinking it's just for compliance. It directly impacts financial transparency and investor trust. On the grant date, companies measure total compensation cost based on fair value, usually using Black-Scholes. The expense is then recognized over the vesting period. A common pitfall is ignoring changes in service conditions. Always match recognition with vesting terms to avoid misstating expenses. Changes in vesting conditions, like accelerating vesting periods, Impact expense recognition timing. Under ASC 718, accelerated vesting requires immediate expense recognition of unrecognized costs. Misunderstanding this could lead to incorrect expense reporting. Always reflect changes promptly to maintain accurate financials. ASC 718 and Indian Accounting Standard 102 differ mainly in fair value measurement methods and tax treatment. ASC 718 allows greater flexibility in valuation models, while Indian Accounting Standard requires specific methods. Tax effects are also treated differently, influencing deferred tax accounting. Don't confuse the valuation models, each has distinct compliance requirements. ASC 718 and International Financial Reporting Standards 2 vary in grant date fair value recognition and tax effects. Under ASC, deferred tax assets are based on intrinsic value. International Financial Reporting Standards bases them on fair value. The common trap is not recognizing International Financial Reporting Standards as stringent disclosure norms. Always adjust for these nuances in cross-border reporting. For a stock option with a fair value of $100,000 and a 4-year vesting period, recognize $25,000 annually. On the vesting date, the full $100,000 should be recognized. Trap: forgetting to adjust for actual service period changes. Always align expense recognition with service changes. A frequent error is misclassifying equity and liability awards. ASC 718 covers both, but companies might exclude liability awards thinking they're not stock-based. This impacts balance sheet classification. Always include both types to ensure comprehensive reporting and avoid restatements. CFOs must disclose the nature and extent of stock compensation, fair value methods, and assumptions used. Disclosures include tables of outstanding awards and recognized expenses. The trap is overlooking these detailed requirements, which can mislead investors. Always ensure comprehensive and clear reporting. Fair value provides a more comprehensive economic view by including time value components, unlike intrinsic value, which only captures the difference between market and exercise prices. Trap 1 lies in this distinction. Memorize. ASC 718's aim is fair financial representation, not just basic market assessments. ASC 718 focuses on accounting for stock-based compensation, ensuring alignment between management and shareholders. It requires fair value measurement at grant date and addresses both equity and liability classification. The standard applies to transactions involving stock-based payments for goods or services. Service period recognition and award modifications are key areas to watch, as they can affect how compensation cost is recognized. Understanding these basics helps in comprehending the overall approach of ASC 718. Grasping the core model and measurement of ASC 718 involves understanding fair value at the grant date and recognizing compensation costs over the vesting period. Vesting conditions can alter recognition timing, while non-public entities might use intrinsic value if fair value is impractical. Fixed versus variable awards differ in measurement, and any modification can necessitate a reassessment of fair value. These concepts form the backbone of the stock compensation model under ASC 718. When preparing for interviews, understanding ASC 718's nuances is crucial. Its differences from International Financial Reporting Standards 2, especially regarding tax effects and award classification, are key. Disclosures must clearly detail share-based payments, while misclassification can lead to errors. Performance awards and forfeitures require careful tracking to ensure accurate expense timing. Being aware of tax windfalls and deferred tax implications is essential for accurate financial reporting and interview success. These insights can set you apart in discussions. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.